Well, good evening. This is the pre-show. Martin North here from Digital Finance Analytics. And a few people on already. Good to see that. Hello, Sanjay. Hello, Andrew. Hello, Mr. Rogers. Mr. Pulse. I'm lost. Just going down the list now. We'll just give the audience a little bit more time to join us. And who else is there? Alex, Freddie, Yusuf. Hello, everybody. We are live. Yes, indeed. Hopefully. And I remember to turn the sound on this time. It sort of helps, doesn't it? Good evening, Lacal. How you going? MG, Mr. Rogers. Good day, good day. This is retracted. Oh, okay. Hello, Harry. Hello, Ray, Lisa, Andrew. There's no try. Dale, Alex. Good to see you all. Glenda, hi. Honey, Peter, Moon, Shadow, Sean, Brendan. Popcorn time. Yeah, I can't really eat popcorn and do this too. So if you're watching this in the recorded version, we'll put the formal start time up. I'm just going to run for another half a minute or so, and then we'll go. Good evening, Sean, pragmatist, waiting for a train. There must be a piece of work somewhere where people have thought about the names that people use on YouTube, because I'm not sure quite where they come from, but some of them are very interesting. I'm afraid mine's just quite boring. Okay, so I think we're going to sort of officially start now. So I'm going to roll the intro, and I'll be back in a second. Well, good evening. It's Martin North from Digital Finance Analytics, and welcome to this live stream event on the 21st of August 2018. Thank you very much for taking the time to be taking your time out of your day to be with me on this stream. And the plan today will be to go through the property scenarios that I've been developing. And to start that, there are a few things I just would like to go through in terms of just setting the scene. So I'm going to switch across to here, and we'll get going. And I'm watching the chat as we go. There's quite a few people asking about Turnbull as well. A few people saying that they like the Adam North chats. That's good to hear. Okay, so just a quick update on the running order. This introduction, which we're doing at the moment, I'll just cover the house rules, just a few things I want people to be clear about. Cover a little bit about the models again, because the models are such a critical part of what we do here. And then I want to touch on a few key slides, and then we'll go through the scenarios and then touch on some questions and answers. I will try and pick up questions as we go through, and I'll be keeping an eye on the live chat, but it may well be that I won't get to all of them until later on. In terms of running time, this is probably going to be 45 minutes to an hour if we sort of manage to survive that long, and then there'll be a sign off at the end. So just a couple of things on the house rules. It's really important to understand this is not financial advice. I am not qualified. I'm not able to give individual tailored financial advice. Don't take it as such. These are just my observations. I do quite a lot of analysis and follow what's going on, but this is not financial advice. It's important that everybody understands that. Second point is, please play nice in the chat room. Last time was great. We had some really good conversations. There's some really excellent ideas flying around. So let's not degrade into abuse. I am actively monitoring as we go, moderating it as we go. This is as at today, 21st of August. In fact, the data is also up today. Last time it was a day early, but today, 21st of August. And just in terms of the model, you probably have seen this chart quite a few times, but this really does take you to the heart of what it is that I actually do as a modeler. So effectively, in the modelling here, we have input coming in from our household surveys, from other sources of data and from public data. It goes into our core market model. The core market model is where we do our analytics, all our segmentation, all our scenario modelling, and then we publish that through to various reports, through to the blog and on the online and through to YouTube. So that's essentially what I do and how I do it. And this model has now been around for about 12 years, and it's developed quite nicely. It's quite big, it's got lots of different dimensions to it, and today we're going to touch on some of the scenarios. And just to give you an example, here are some of the dimensions in the model. It's deliberately multi-dimensional. Think of it like a Rubik's Cube. You can sort of mess around with it and slice it and dice it different ways, and we can drill down into postcodes and into particular household groups and all sorts of different ways. So that's how the model works. Okay. Alex says, very few economists telling the truth. What is truth? Well, hopefully you get some truth here, because truth, to my mind, is driven by information and data rather than just opinion. And so what I try to do here is provide real insight based on data rather than actually just plucking high-level ideas out. So hopefully that comes through. Okay. Just in terms of something else, if you're going to ask me to ask a question that you want answered, can you put the world in front of it? Because I may not see that there's a lot of activity in the stream at the moment. There's about 117 people on so far, and you know, we're only 2 minutes in. So the chances are, if I miss you, I apologise. Ask it again. I'll try and look it back over as well. I go. Okay, so just a few points. This is actually the reserve minutes today. The RBA minutes came out today, and just to highlight that they're talking about further declines in home prices in Sydney and Melbourne. That's pretty much, I think, well known, but it actually is accelerating in most areas now, particularly in the main urban centres of Sydney and Melbourne. Continued declines in Perth as well, a little bit more stable in Hobart and Adelaide, but in fact the demand there is also easing. And whilst they say rental vacancy rates are little changed, in some areas of Sydney and Melbourne now, the vacancy rates have risen. So that's quite an interesting observation. But the next one is just on employment. So they're again talking about the growth in employment, and you know that in some of my earlier posts I talked a little bit about the nature of employment. Question, of course, is, are the numbers right? And the real news here is, whilst unemployment rate is relatively low, you know, around 5.5%, it's nowhere near the 5% that needs to be to perhaps see wage rises. And on some measures, the rate of increase in terms of people looking for work is a little higher now. So the participation rate is not as good as it was. So the RBA is still very positive, very bullish. Sound is getting tinny, buzzy and distorted like AM radio in the mountains. Oh dear, now why is that? Video stream is down. Okay, that's interesting. Well, it's telling me that I'm streaming and the stream is good, so I'm not quite sure if other people are having difficulty. People are still chatting, so I'm going to continue. Just check. Yep, I'm still up, still live. Yes, so suggested on the stream there, you should reload refresh the page. Certainly I'm still streaming, and the audio is reported okay here. So thank you very much, Andrew. Andrew's confirming the sound is good. Peter the same. So looks as though it may be your end rather than mine. So I'm going to continue. So just in terms of the forward-looking indicators, they're saying that wages growth is expected to increase gradually as spare capacity has absorbed. Now the question is, will it? And thank you, John. Yeah, everybody's saying, yeah, okay, yeah, good. Okay, I think we've got the message. Looks as though there may be one or two people struggling, but I can confirm that the stream up to YouTube is working fine at the moment. Okay, just in terms of another piece of data, this is a really critical piece of data. So this is showing you the annualized growth rate. And the point to make is that even now, credit for housing is still growing at more than 5% per annum. That's scary, right? When you think that we've got home prices sliding, when you think we've got income static and cost of living rising, we've still got credit growth in the system. And in fact, owner-occupied lending on an annualized basis at 7.8%. That is remarkably high. I discussed this in one of the earlier posts, another housing record set. So have a look if you want more information on that. The point there is we have not yet got credit growth under control. Another quick one. Mortgage stress still rising, so 30.4% of households, owner-occupied households, are now in mortgage stress. That's an all-time record. And the point about that is that means that households are struggling with cash flow, paying all of their bills and also their mortgage repayments. And that's the critical forward-leading indicator of trouble ahead. And so if you put high credit growth on one side and you put high mortgage stress on the other and flat income, you can begin to see the problem. I discussed that in recent posts, lending, stress and all things DFA, so have a look at that if you want to follow up on that. And then we can look at the household financial confidence. So as well as, yes, I'm recording the stream here, and I'll put it up as well in a hi-fi version at the end of the show. I can only stream at 7:20 at the moment. I'm waiting for the NBN to get their act together, so we're doing the best we can at the moment. Household financial confidence is falling. This is where I measure all of the dimensions of household financial confidence, and it's lower than it's been for quite some time. Anything below 100 means we're in negative territory, and we're still seeing households saying income's a problem, costs are a problem. I'm seeing house prices sliding. And it's investors who are really now in low areas of household financial confidence. They're actually down in areas close to those with who are in renting or in other living arrangements, whereas they used to be way high. So it's the investment sector that's really evaporated in terms of confidence. So there's a few people suggesting that the question is, should we lift interest rates now? Yeah, well, you certainly might. Of course, if you do, then you're going to lift the number of people who are actually in difficulty, and that takes us nicely into some of our scenarios that we'll talk about in a second. I just wanted to show you this slide. This is where I measure the bank bill swap rate, the BBSW. And the BBSW is the effectively the rate at which banks are able to borrow, and it's actually come back. It was sort of 32 basis points gap a month ago, and it's now come back. What that means is that the funding pressures, you see us asking how the survey is done. We survey 52,000 households each year, 4,000 a month, 1,000 a week. So we're always getting new data coming in, 1,000 new each week. The oldest 1,000 drops off the back. So we've always got in our model 52,000 separate, distinct households. Somebody's saying so waiting for training. We haven't had a recession for a long time, so people don't know what it is. That's true. And also the market can maintain its irrationality for much longer. It is hard to invest, I agree, at the moment, Eric, indeed. They could lift a little, but they tend to move in 25 basis point notches, John. That's just the way it is. Okay. Said pretty rainbow. This one has a chamber board at the end of it. Yeah, I think you're probably right. So 19 basis points is a lot lower, but still banks are reporting in their recent results that they've got funding issues. So effectively, we are still seeing pressure on bank funding. Therefore, the ability to actually take rates lower is restricted from a bank perspective, although the Reserve Bank may do something different. Okay, so kill off negative gear on existing housing, says Andrew. Oh, yeah, you might want to do that from a rationalistic perspective, but of course all the politicians would say that they get killed at the polls if they did, and that's one of the challenges of this particular problem. Okay, fourth scenario. So here's the thing. trying to understand where this market is going and how it might look is quite complicated and difficult. And, you know, you'll hear sometimes people being asked to sort of make a prediction about where it's going to be in 2 or 3 years' time. And frankly, that's very hard to do. So what I do is I develop a range of different scenarios using the modeling as an input. And then I think about what the implications of those different scenarios might be. So it's really not a forecast, but it's really to help facilitate the debate and discussion, and effectively to see how things may pan out. Now, none of these scenarios may turn out to be right. It could well be that they're all completely wrong, and we'll know. If you check back and watch this video in a couple of years' time, you'll know whether I was anything like right or whether I was anything like wrong. But when I did these scenarios earlier in the year, I started laying out these different alternatives, and they've actually proved to be quite helpful in terms of trying to understand precisely what it is that may be down the track. So we use the framework from our core market model, and now we're going to look at the 4 potential outcomes updated with the latest data so that you can begin to see how it might turn out. So this is the first one, which I call business as usual, and this is the one that the Reserve Bank would like to happen, because basically there's going to, in this model, credit growth continues to ease a little. Effectively, there is going to be, a credit sliding down to becoming a little bit more rational. There will be some continued fall in home prices, but not a huge fall. Employment will stay around about the current levels. The Reserve Bank will still bank on household consumption supporting growth, and the broader GDP numbers will look pretty good because essentially they will still be supported by some of the exchange rate movements and from the demand for commodities. So the business as usual scenario is, if you like, the best case that I can see at the moment. Now the question is, in that business as usual scenario, the best case, what might the outcomes be? Well, to try and do that, here is my estimate of what we could see in 2 to 3 years' time. So the first thing to say is that we think the Reserve Bank will not move its fixed rate, cash rate, anytime soon. So I still think it'll be around 1.5% in a couple of years' time. I think unemployment will be just a little lower. I think the mortgage stress will be a little higher from where it is today. So there's about 970,000 households who are currently registering as in mortgage stress. So we go up to pretty much the round million households. The bank losses will rise a little, so 3.5 basis points. Just to explain that, that is the net losses the banks effectively make once they've sold the property and effectively clawed back all the losses from lenders, mortgage insurers. It's the net deficit that they have as a percentage of the total book. So traditionally it's been as low as 2 basis points, so it's going up a little but not dramatically. But my best prediction is that home prices on average will be down 10 to 15% over this period of time. In some postcodes it will be significantly further down than that. In other cases it may be a little less, but on average 10 to 15%. And there's also what I call unnatural acts. So these are that we're going to see interventions in the marketplace that effectively is going to try and prop things up. And my argument is, in this scenario, if this is the one that plays out, you don't really need to do much other than just let things run. So effectively no unnatural acts. But my probability rating of this scenario is just 5%. So I am really not very positive and confident that this is the scenario, this is pretty much the Reserve Bank scenario, that this is the one that's going to actually win. And I'll explain why as we go through the next scenarios. So that's the best possible outcome. Somebody's asking about lenders, mortgage insurers. Okay, let me just talk about lenders, mortgage insurers. Okay, LMIs are these dedicated insurers of loans above 80%. And there are some captured within the banks, but there are 2 independent ones, Genworth and QB LMI. And they basically protect the banks between 80 and 100%. Okay, so if you're borrowing at 90%, then you need to pay for lender's mortgage insurance to be able to cover the difference. Now, if house prices go down 10 to 15%, some of those will actually potentially be exposed. And the regulators require lenders, mortgage insurers not to be cross-subsidized from other business streams, so they're actually as a standalone business. And in the US, it was actually LMI that actually created one of the pools of discontinuity in the US, because the LMIs basically fell over. So that's LMIs, and yeah, I think we've got some questions there. In fact, if you look at the most recent reports from both QBE and Genworth, they both reported higher default rates. Second scenario. Okay, so you can sort of tell how this is going, right? Because we're going to go into more and more gloomy territory as we go through the scenario. Second one is what I call things can only get better. I think there was a pop song that a few years ago. So here, effectively what we're going to see is greater impact of the international rate rises that are actually flowing, particularly from the US, but also perhaps from the UK and Europe down the track. And that's going to put more pressure on rates here. Somebody's asked me about the Aussie dollar. I'll come back to that in a second, Duncan. So effectively, with rates going up, we're going to see effectively the need to do something about that, because effectively the exchange rate will drift down. I think that in this scenario, we could see the exchange rate below 70, even below 65. Some people are suggesting in the worst case scenario, we could be down to 50. Not in this scenario, but I think in a couple of the others. So yeah, exchange rate goes down. RBA is forced to lift rates, because essentially you've got to respond to the exchange rate. You can't let the rate go down too hard. And initially it'll be 50 basis points, but there'll probably be more to come. As a result of that, credit growth will slide significantly more. But as interest rates rise, the amount of mortgage stress grows, and the loss rates begin to rise, and home prices then slide further. So effectively you sort of see this cycling down. And so this is effectively the one where it's driven purely by interest rate movements internationally flowing into Australia, and then the Reserve Bank having to react. And of course the Reserve Bank has been talking quite recently about the next move in rates will be up. So, maybe not too many surprises to think they might lift rates. Not necessarily immediately, but we're talking over 2 to 3 years here as well, of course. So what does that do to the model? Well, here we've put the RBA rate just at 2%. So not a huge uplift, it could be higher. Unemployment will go higher, not dramatically. Mortgage stress will go up. The bank losses will be up to 5 basis points. And apartments also decrease 10 to 15%. Sean, I think in some places apartments will probably drop even more, particularly in some of the new apartments in the CBD areas, like in Brisbane and Melbourne, in some of the areas in Sydney as well. Generally, apartments seem to be more sensitive to rate moves than houses, partly because of the types of people who are actually working there. Home prices in this scenario down up to 20%, maybe more. Apartments probably a little bit more. We will see reactions to this. With easing credit rules. So the way that will work, APRA will say the banks now have been proven to have the tighter underwriting standards, so they can actually lend a little more freely, and they'll actually encourage probably investors to borrow. Not many will probably do that. So effectively we see a spiraling down of credit growth. In fact, it probably could actually turn negative. We see home prices down 20%. And overall, my probability of that is 35%. What does inflation look like in this scenario? Peter, it's an interesting one, because basically there are going to be two conflating forces. The first is we're going to import inflation from overseas. The exchange rate, if it drops too far, will actually force inflation up. But then the Reserve Bank will effectively be able to lift rates as well. I think in this scenario, we're looking at inflation between their target of 2 and 3. In fact, it's towards the upper end of it over this particular scenario. Now, I give that a 35% weighting. So I think this is reasonably realistic. We're already seeing potentially 2 more rate rises from the Fed perhaps September and December. We may expect to see more than that, but that's enough to move those international rates higher. And remember again that banks here in Australia are totally reliant on international funding to fund their book. So effectively, as those rates rise, it has a direct impact on them as well as the exchange rate impact. But my argument is it's the exchange rate impact that's actually the most significant, because that has a broader impact in terms of inflation, cost of goods, even things like cost of fuel and those things as it comes in. Tubbs has asked, is it a good time to fix your home loan or hold off a bit? Well, it depends whether you want to lock in for security reasons or whether you want to lock in because you think it's the best rate you can get. I actually think that rates, especially for some lower loan-to-value refinancing households, probably will never be lower than they currently are, because there are some remarkable deals out there if you've got the capacity to get down below 80%. If you've got a higher loan-to-value ratio, then you can't get any of the good deals that are there. And by the way, just so you know, we've reached over 200 now on the stream, which is terrific. That's a record. Okay, so let's go to the next one. So this is not yet doomsday, right? So this is still a little bit of a more gloomy run. So here we now. This is now where we really get into the interesting stuff. So US rate rises happen, right? But what they start doing is triggering pressure in the US economy, because firms are borrowed up to the hilt. For example, many US firms have actually been borrowing at low rates to then effectively allow them to pay out significant dividends to investors. So a lot of US firms are highly leveraged. The household sector in the US is quite leveraged, but nowhere near as here. But effectively that starts to trigger a pressure in the USA. And that then means that we start to see some movement in the US dollar, and we also see some flight to quality. Initially it'll be to the US dollar, but it could actually begin to flick over to gold if the US dollar starts looking a bit flaky. And remember that the share price in the US is quite near the top. Remember that interest rates are still in absolute terms quite low. So effectively my argument is that this is quite likely to happen. Now, through this process, as rates rise, one of the critical things that will happen is that capital from Australia, and there's a lot of overseas capital here at the moment, could well exit simply because they can now get better returns in the US than in Australia, and it could be that the risks are a little lower. So that means that essentially, on one hand, you need to lift rates higher here to try and retain investment, and yet this would actually have a significant impact on the local economy here, and you probably need to cut rates to try and stimulate the local economy. Now, in this scenario, the funding for the banks begins to get difficult. The interest rates probably go a little, but we start to see high levels of defaults, and we start to see some pressure on the banks. And there's one bank, particularly this particular bank, probably because of its investor loan portfolios, will probably have significant risks coming through. And not all banks are equal here. Some are actually more and some are less exposed to the way this could pan out. So this is where we start to see the first cracks in the banking system. And as you will see as we go forward, effectively the fact will be that the banks themselves now start to get into a bit more difficulty. Okay, so this is how it pans out. So Reserve Bank rate, I'm saying 2%. Employment rate now up to 6.5%. That's quite a big uplift, right? So we're at 5.5 now. It'll be quite a lot higher. But the other important point there is that the ability for people to get overtime and underemployment doubles from where it is now. It's already quite high, but it will go up a lot higher. So what would happen, a bit like last time, we'd have people wanting to earn more but unable to. Mortgage stress up to 35%, so that's well over the million now. Bank loss is higher at 6 basis points. Home prices now, and this is where it gets horrible, 20 to 30% is my estimation of what that would do to home prices. And again, it's not equally split, but the major centres of Sydney and Melbourne is where a lot of the action happens. Brisbane would also come off, but Hobart and Adelaide would also be impacted to an extent. Not quite perhaps as much, but actually still significant. And I've highlighted here, one bank is likely to need a bailout in this scenario. simply because they would be unable to get the capital they need to be able to keep themselves afloat. Not sufficient to upset the whole banking system, but effectively you'd probably have the RBA intervening. You'd probably have some of those reserve that they have handed across. There might be some restructuring of this particular bank, and essentially, I don't think it would actually collapse, but it would need external assistance. Probability of this one, 40%. So it's actually not that far out from potentially being there. This is a big deal. Okay, so that's my sort of not quite doomsday, but it's getting close. And this is really which will be on the bank. I'm not going to tell you which bank, more than my job's worth, but you can suggest a few, and I won't say anything. Okay, Armageddon. Now this is the end of the journey. Okay, so this is when things go really pear-shaped. Okay, waiting for a train asked about gold. Let me talk about gold. Okay, so here's the thing. Gold prices have drifted lower for the last year plus. And in fact, everyone is a bit surprised by that, because people would have thought that there'd be a flight to quality. At the moment, the flight to quality is to the US dollar. And the strength of the US economy, the tax cuts that Trump put in, and a few other things, basically makes it very attractive for people to use the US dollar as the default low-risk currency. Question is, could gold become more important if in fact the US starts to wobble? And there are two schools of thought. The first is that it could be that the US dollar effectively diminishes in its capability to be that default risk, low risk, in which case gold could actually begin to move up. But then the question is, how do you price gold, and who prices gold? Some of the big institutions are actually taking positions in both gold and silver at the moment as a way of protecting some of their assets, or more likely, I think, taking positions because they think they can make a motcha if it actually does move. So, not sure, but I suspect that gold will languish for a little bit longer, but it may go up a little. But remember this, if you hold gold physically, you've still got to be able to actually sell it later, and nobody quite knows the price first. Second is, of course, there is that old statute that basically allows the government to buy gold at whatever price they like. Just bear that in mind. Okay, Armageddon. So here we are. This is now the horrible end of the stick, right? So this is where all of these things begin to fall apart. So effectively, we have some sort of international crisis. It could be, it could be US-China trade wars. It could be, strife of, you could basically list a whole bunch of different ones. It could be that the situation in Europe and in Turkey spills over, and Spain and then Italy gets caught up in it, and then it trips over, and Deutsche Bank gets caught up into it. You could see that scenario playing out. You could see a scenario where the Brexit thing unwinds, and effectively that creates tension and pain. I mean, I could list a lot of different crises. I'm not going to. The point though there is that whereas the other scenarios we are sort of just hit with a sort of series of impacts relating particularly to interest rates and exchange rates, this is more significant. Caught in the tide. It's a bit like the GFC all over again. And yeah, as Bruce has said, it's really deflationary, depression. I mean, it's as pretty much as bad as you can get. Caught in the tide is what I put here, because basically what it means is that we'll get flooded with issues. Unemployment will lift very significantly. Defaults will go up significantly, and we will see a bunch of unusual measures, right? And I want to here draw parallels between what happened in Ireland and Australia, because this is effectively Australia's Irish moment if we actually go down the route, because we've got all of the same phenomenon in place. We've got high debt, we've got massive leverage, all of the stuff that we've been talking about in the process, and John and I have been talking about. Yusuf said, Armageddon is what I wish for. Let's just be careful what you wish for. It could be nasty. In fact, it could even be worse than Ireland. Okay, so let me just reveal what I think could happen. Okay, so first is, in this scenario, we could actually end up with zero interest rates. So the Reserve Bank will be forced to cut. And as we discussed a couple of days, one of the ones with John, zero interest rates are pretty scary because effectively it means that you get penalised for holding any savings at all. Yes, Kundi. What, you want a 5 to 7 year scenario? Oh, goodness me. I'll talk about that in a second. Okay. Employment rate, 8.5 to 9.5 is my suggestion as to where it could end up in this scenario. And the mortgage stress rates will be 38 to 42%. So this is now more than 1.2 to 1.3 million households. Bank losses at least 12 basis points, but I think that's conservative. I think actually it would actually be significantly higher. I think home prices at least 30 to 45% down. And again, I think it will be a little bit spread differently, but here pretty much all property in all locations, all types will get caught. And we will see a whole bunch of unnatural acts. So we'll see, firstly, bits of bailout. So effectively, some of the banks will need to be bailed out. There will be a limit to how much capacity the government has to bail out via the RBA. I also expect to see some sort of bail-in. The bail-in could be those derivative products that some investors have vis-a-vis the banks. Of course, there is a sort of slight crack in the door with what happened in in terms of bail-in of deposits. Who knows? The legislation is fuzzy, and we've discussed this before. So essentially, this could actually go pretty bad and pretty quick. Probability, 20%. I put this up. So basically, when I did this scenario last time, one, my probability was a lot lower, and two, the losses and the home price falls were nowhere near as serious. Right? So this is essentially our Irish moment. And just remember this, that it took the Irish 10 years, a decade, to begin to actually pull this back. Because that's the thing that it's worth bearing in mind. This is not something that effectively happens and will bounce back in just a week or a month or a year, right? And one of the things about the APRA's stress testing was they had a sort of a mild perturbation down, but it bounced back quite quickly, right? In this scenario, there's no significant quick bounce back. So this is a bit of a nightmare sort of scenario, and frankly, it would not just be, of course, Australia that will be caught up in this. This would be part of a global thing, and that being the case, you could see how this could actually run and run. And just to make the point, another unnatural act here is that banks would not foreclose on people with mortgages, because essentially what happens there is that they, if a few people default, the banks can foreclose, get the property and sell it. But if 1 million people default, then they cannot deal with it. So effectively, they'll have to renegotiate mortgages, extend the life of the mortgage, essentially help people to sort of stay in their properties, right? Which is why a lot of the issues are in the banks. Okay, Mr. Sweetness, will the banks give its depositors worthless shares if bail-ins happen? Well, yeah, the scenario in New Zealand, and New Zealand has expressly said that deposits in New Zealand banks are actually available for bail-in. The idea is that it would take some of the deposits, prop up the banks, and give the rest back. So effectively, you might end up with a haircut of your deposit, and perhaps not have accessibility to it for some period of time. The fact is that the bail-in thing is one of those things that is not wanting to be talked about much. APRA has said several times, we'll never bail in deposits, right? Or in fact, they said we'll protect depositors. And the trouble is that there's some fuzziness around the language which suggests that in a crisis you could see some really unnatural things. So Sanjay says, it's rubbish to say that in 2018 Australian banks are well regulated. Is it rubbish to say that in 2008 Australian banks were regulated the way they were in 2008-9? Look, the fact is that we have seen through the Royal Commission and through some of the other things that have been going on that the regulatory framework in Australia is pretty weak. We actually have the RBA doing dumb things on monetary policy. We have APRA really not doing the right things in terms of actually the bank regulations, and we've had ASIC doing some things but very slow. And both APRA and ASIC essentially trying to sort of work with the banks rather than actually being regulators to the banks. And remember that those three people plus the Treasury sit around the table in the Council of Financial Regulators, and it's that regulatory body that's essentially responsible for managing the system in Australia. Now, I think that we need an extension to the Royal Commission specifically to look at bank regulation, because essentially we have massive issues here which have developed over a generation. This has not happened just in a few months, right? Essentially for the last 10 years we've had monetary policy way off where it should be. We've had poor regulations, and everybody in those official bodies have been drinking the same Kool-Aid, which is that more debt is better because debt stokes up GDP, debt encourages households to spend more, debt allows people to support the broader economy. And the trouble is that we've built ourselves into this situation where we've got 190 debt to income ratio on average, of course much higher for many households, where we've got banks who are actually highly leveraged, and we've got regulators who are relatively ineffective. So it looks to me as though a lot of these things are actually tied up. Now, somebody's asked about auto loans and student loans. Yeah, interesting question. One of the things I've been looking at recently is the debt that's other than mortgage debt. Because, of course, everybody talks about the 1.7 something trillion of mortgage debt. But there's still growth in consumer loans. And if you look at households, as I do, rather than actually just the individual loans that the banks do, what you see is you see multiple piles of debt, including mortgages and consumer debt and credit card debt and lots of different forms of debt. And in fact, the people who are in more mortgage stress tend to have more credit cards, tend to have more debt. The other interesting thing is, talking specifically about student loans, is a lot of young people, of course, as well as finding it difficult perhaps to get into employment sometimes, when they go to university or to college, they have to pay much more and accrue these debts. So they start off their life with a level of debt that frankly is remarkably high, and then they're expected to incur more debt and more debt to effectively go get a home. And what this talks to me about is the intergenerational unfairness here. So effectively, at one end of the spectrum, we've got people who are sitting on assets that are bubbly overvalued, and we've got younger people with a lot of debt trying to get in. So we have a whole bunch of socio-economic issues here. Okay. New cars everywhere, says Donna. Yes, I agree, it's weird. And it's interesting that the research that Reserve Bank published some time ago said that when households get money, particularly if they're in the slightly more battler areas, they're more likely to go buy a new car. And interestingly, some of the refinancing that we're seeing at the moment in the market, and there's still about 20% of loans being refinanced, some of that is still releasing equity out of those properties and then going to buy cars plus holidays. So we still have got this debt spiral, and that's one of the reasons why overall debt is still rising. Now, interestingly, the statistics that are published by the RBA understate lending from non-bank sources. So effectively, the work I've been doing quite recently is to look at the other types of loans coming from the non-bank sector, which is actually a significant and growing. It's growing a lot faster. It's growing between 5 and 15%, whereas credit card debt is growing much more slowly. So yeah, got to look at debt in the round. Okay, Q&A. All right, so there you go. So that's my sort of thoughts in terms of the scenarios. And I'm happy now to look at some of the questions. Now, I will just go back over the stream and see what people have been talking about. Could RBA initiate QE? Well, yeah, interestingly, they have unofficially been doing QE by just allowing credit to grow, right? Because the money supply has grown a lot faster than you might think. John did a very good video with me on that a little while ago. Go and have a look at it. So could they formally do it? Absolutely they could. I think that there are chances that they will do that. They will be looking to try and kick the can down the road. And just bear in mind, of course, that there will be an election sometime over the next year or so, maybe sooner than we thought. So it could well be that, again, you don't want to actually see home prices drive too much lower. So there may well be some efforts to try and sort of stimulate the economy a bit and keep the ball in the air beyond the next election cycle. But the point there is you keep kicking the can down the road, you just build the problem into a bigger problem, and every time you build into a bigger problem, you create more of a fall below. And my scenarios were pretty clear. These are significant falls, and many households will suddenly see that the value of their property, the paper value, is 40% down or more. That's a big deal. Has a significant impact in terms of household confidence, has a significant impact in the broader economy. And the frustration that I have, I guess, is that we don't have clear strategy for a future growth path for Australia. And that's a big deal, because essentially we are just reliant on the same old, same old. Now, the fact is other countries around the world are doing precisely the same. It's all driven by the same central bank group thinking. It's all driven by the same Basel ratio risks and all of that. And there's a whole bunch of questions that we can discuss there about why it is that really that doesn't cut the mustard when it comes to dealing with some of these issues. So, yeah, short answer is RBA could definitely do QE. Let's see what I can find. Okay, what is the default refinance rate now? Okay, this is from B. Sultan. Okay, so at the moment, the refinance rate is sitting at around 20%. That's the people who are refinancing their, for example, mortgages. It's gone up a little in recent times because of all the really cheap deals, as I discussed earlier, particularly for those with low loan-to-value ratios. The default rates at the moment in Australia, in terms of the data from Moody's and Standard & Poor's, are suggesting that the 90-day defaults have moved up just a little, sort of 0.6 or thereabout, which is still low, so 0.6%. But essentially, overall defaults are sitting just over the 1%. It varies a little bit by location. It's higher in Western Australia. We are seeing default rates rising now in New South Wales, particularly in some of those suburban ring areas. And we're also seeing now some of that in Melbourne. I'm watching Melbourne because I think Melbourne is now playing catch up on Sydney. You can see the auction clearance rates a lot lower. I'm seeing default rates beginning to rise in Melbourne, and mortgage stress is now higher in Melbourne. And another little piece of information about Melbourne is that the net rental yields in Melbourne are lower than almost anywhere else in the country. So defaults will be higher there. And then we haven't even started talking about interest-only loans and how they're going to get refinanced. Okay, what else have I got? What's the best means of shorting housing market in Australia? Says Villas. Yeah, interesting question. There are a lot of international investors looking at the Australian market and saying, we want a bit of that. And it's interesting because I speak to perhaps 20 or 30 of those hedge funds and investors overseas, a month. I've had more in the last quarter than I've had previous 5 years. They're all really interested in my data, which is good, but they're also interested in trying to work out how to short. It's hard to do here because there are less derivatives than in some other places. Some people argue that you can effectively short the banks because effectively, 60 to 65% of bank lending is for home. You can short some of the property companies potentially, but it's pretty tough to do. And in fact, some of those investors that I spoke about are working with the investment banks here to create synthetic hedges against property and against the banks to try and capitalize on these downward falls. So I was talking to one earlier in the week, this week, who was basically saying, yeah, we think we're in for a significant harm drop and they want part of it. And I guess the point I want to make here is that the whole international financial structure, particularly from the investment banks, is all about trading on the movements, right? So it's actually not very good for the economy. It's not very good for individuals or banks, and yet that's the way that the financial system has developed. So effectively, my argument is it's the international finance players who are really calling the shots, much less so actually probably than the governments. Okay, let me see what other ones I've got. Did you see Gosford first-time home buyers increase from 80 to 550 years? Yeah. Sorry, trying to read that one. It's moved. Hang on. What's that? From Mr. Rogers, did you see Gosford first home buyers increase from 80 to 550 year on year? All the credit limits are forcing the Sydney investors out west and up north. Yeah, that's true. So we're seeing significant drifts out of some areas. And I'm watching the Gosford area and the mid-north coast particularly because there the mortgage stress is significantly higher than it perhaps may first appear. And you're right, there are investors also doing quite a lot up there now, whereas previously they'd actually go elsewhere. I'm also seeing quite a few investors, particularly what I call the more sassy ones, who've sold now in the Sydney Basin and are looking either to invest in Adelaide or Hobart because they think that effectively the top has gone and passed. Okay. What about hybrid bonds? Are the value of those securities enough to cover bank losses considering the CET1 requirements? Isn't that why APRA set the ratios in the first place? That's from Neil B. Yeah, so the hybrid bonds are interesting, right? So basically the hybrid bonds can be activated at the point when there's a problem. And of course, those are supporting the capital ratios quite nicely. So within a certain set of parameters, they'll work fine. The problem is that the size and quantum of the potential losses that the banks will need to cover are a lot bigger than I think APRA modeled. So APRA did some stress tests. In fact, John Adams and I did a video a few weeks ago on that, on the whole stress testing thing. And what we argued was that the Armageddon scenario that the APRA was using was not Armageddon at all. It was nowhere near. Conveniently, the banks didn't have a problem. They could call on some of their hybrids and things. My argument is that the quantum of losses we're talking about here over the 3 to 5 year term will be so large that effectively the hybrid structures wouldn't be sufficient to cover it, and effectively there would be a significant shortfall. We'd probably have to have some restructuring of the banks in Australia as a result of it. Okay, what else have we got? Okay, see, just going back through the stream. Have we got 6 months to take the money and run before the music stops? I'm lost. Yeah, look, my reading is this is not going to happen tomorrow afternoon, right? We're going to see this play out over the next 6 to 12 months. What I would say is that compared with March when I ran my scenarios last time, the rate at which home prices are falling is about twice as fast as what I thought it was going to be then. And so the question to me will be, let's look at what happens in the spring. If we get any sort of a bounce in the property market in the spring and we see lending continue to grow and we see property prices go sideways rather than fall, then it might take a little longer. If in fact we see, as I think we most likely will, see continued auction clearance rates diving and we see home prices continue to slide and the contagion of sliding home prices spreading more broadly, then effectively that's going to be the indicator for scenarios 1, 2, and 3. So far as scenarios 4 is concerned, which is driven very much by, the vagaries of what Trump may do or what China may do or what Europe, it's hard to know, right? Because those are the things that, in my mind, have the potential to create significant disruption quickly. And the trouble with that sort of disruption is it touches not only the main banks and mortgages and those things, but also touches the derivative markets. And one of the things I'm concerned about is the way that the derivative markets have just ballooned since 1999, 2000. And we've got to the point where the derivatives are actually still the biggest risk area in that Armageddon scenario. We've got a huge pool of derivatives here in Australia. Globally, the derivatives market is even bigger. And a lot of those derivatives are actually taken by the big investment banks. So effectively, they are exposed in a way that probably no one fully understands. And that's another reason why I think that these things could happen. So what I'm really saying to you is that while some of the scenarios will play out, over months, there is a risk that some of these more Armageddon scenarios could happen much quicker, driven by those international events that I've just mentioned. Okay, what if ongoing overseas migration and government spending in infrastructure provides a demand for new housing credit, keeping the market steady rather than the big fall? That's from Glassdoor. Good question. Okay, so one of the questions I get a lot is, surely, migration is sufficient to support home prices in Australia. There's, let's say, 200,000 or whatever the number is a year coming into Australia. 200,000 is roughly the number of properties that are actually due to come on stream. So effectively, it's sort of a net. Now, I've done some sensitivity analysis on that. In fact, there's an earlier show that I did on the question of how migration impacted home prices. My argument is this. Migration is a factor, but it's by no means as big a factor as most of the housing sector and most of those looking in from the real estate view argues. It's actually a bit of a furphy, because if you look at the ABS data, the census data, the number of people per dwelling in Australia has not moved for 20 years. If it was a migration-led situation, which basically meant we didn't have enough property, which meant that there'll be a floor for property, you'd expect those percentages to rise, but they're not rising, firstly. Secondly, what's interesting is that, of course, you need to look at the net migration, because people are also moving out as well. And the migration is also not uniform across Australia. So there are some postcodes where potentially there is a shortage of property. But there are many other postcodes where there is not the same shortage. And overall, I completely reject the idea that there is a floor on home prices thanks to high migration. In fact, if you turn migration down, as some people are now talking about doing, then effectively you just take another small support away from home prices. But nevertheless, there would be not a huge impact. The truth is, home prices are fundamentally driven by credit availability. And as we've discussed before, credit availability is not driven by deposits, but credit availability is driven by the bank's ability to create credit and then lend it. And just to recap that argument, traditionally the argument is that you create deposits. Once you've got deposits, you give your money to the bank then lends it on. That's the classic economic theory of how banking works. It's wrong. It's completely reversed. Banks create loans. I've seen it happen. They create a book entry. They create a loan. That loan then creates the ability to buy an asset, or it creates a deposit. And banks can go on doing that and doing that and doing that until there's nobody left to borrow. And so it's actually the bank's ability to create credit that's the critical question to address. Because if we don't do that, then effectively we'll just get more and more of the whole of industry and the whole of society into financial services, and that's really not productive in its own right. And the point about this whole approach is that the Basel ratios and all the other stuff, the fractional banking arguments, right, which is how you control it, are flawed, because essentially it's built on this other view that it's deposit-led rather than actually the reality, which is that it's actually credit-led. And that fundamental change of viewpoint is now being accepted by Deutsche Bank, the German central bank, as well as the Bank of England and other central banks. So they're beginning to see that there's a different way of thinking about banking. That takes you into a completely different discussion about then what do you do? How do you control banking? Because effectively you can't control it using just the Basel capital ratios. It doesn't work. You can't control it simply trying to control via deposits and the ratios. So you need a whole new set of metrics and measures. And so that's one of the things that I keep promising I will come back to it. The Chicago plan is a way of thinking differently about how to deal with banking. Okay, now I'm way behind on the queries. Let's have a look. What else have we got? Okay, just looking to see what else we've got in the stream. Save me back, create money and call it credit. I want to become a bank. That's from George. Yeah, absolutely. Yeah. The financial system is amazing, right? Because essentially, since the deregulation of the financial system in the 1990s, the proportion of the society that it actually occupies is huge, right? It has grown and grown and grown. I was talking to Robbie Barwick from the CC the other day, and he was saying it's like a cancer; it just gets bigger and bigger, and sucks out the life of everything else. And that's where we are really at the moment in our financial system. So effectively, we've lost the view of what banks were for, which was to help productive things to happen in the economy. Banks are now seen as profit centers in their own right, which basically means that they want to lend more and get bigger and bigger. And frankly, that's going to end in disaster. Is there a price bracket? Oh, I moved it. Hang on. Is there a price bracket of the housing market that will affect more than others? Yes, Peter. Good question. Okay. So at the moment, what we're seeing is falls at the top end of the market. When I say top end, I don't mean the sort of the $5 million plus. They're completely, on their own. But between about the 1 million and the 4 million, we're seeing 25% drops in some areas now already in some suburbs. 25%. Whereas at the bottom, down in the sort of the 300, 400, there the price falls so far have not been so significant. And that's partly because there are more buyers, first-time buyers in particular, and partly because the leverage ratios are very different. So what tends to happen in a downturn is that it's the top end that goes first, but that top end then spills down to the rest of the market as the thing progresses. So my argument is it's quite likely that we will see more falls coming down the decals, as it were, over time. And we should be looking particularly at Sydney and at Melbourne. And I said earlier on, Melbourne is the one I'm really worried about. I think we're going to see faster falls in value in Melbourne than in Sydney. What's your opinion of land tax and stamp duty, says Fly So Good. Is it too high? Would it happen if they were scrapped? Okay. Stamp duty is one of the main revenue-raising things that the states use, particularly, for example, New South Wales, right? Huge amount. About 30% of their total revenue, I think, comes from stamp duty. They will be extremely loath to give that up. But it is a tax on housing transfers, and it does mean that it's tougher to move, particularly if you've got a larger, more value property. There is an argument for saying that the whole economic structure here, where effectively you've got land tax and stamp duty, is getting in the way of good economic policy. But I don't see that there's going to be any change to that anytime soon, because my belief is that essentially the incumbent local authorities and governments are so reliant on all of those revenue raisers. They're going to be really worried by the downturn, and even in New South Wales in their latest budget papers, they basically forecast a small fall in home prices and then a rise in 2 or 3 years' time, which I think is unrealistic. So effectively, they're not actually being honest with their budgets. So I think it's unlikely that will change anytime soon. Mr. Sweetness says, good luck becoming a bank. Where's your cool 20 million lying about? Well, that's interesting. What's fascinating about a bank, do you realise how leveraged they are? So if you look at it, about 5% of a bank's capital comes from the shareholders of the bank. 95% of the capital is then created off the back of it. So banks are some of the most leveraged investments in the world, which is precisely why they have such large returns. It's remarkable that people, forget that. And whilst people talk about the risk-weighted capital and those ratios going up, the fundamental leverage between shareholder capital and the assets held is hardly moving at all. So they've still got risks there. It's a remarkable business if you can be on the other end of it, I guess. Okay, what else have we got? With 2 in 3 owning their own home, rising prices is desired. I can't read this, sorry. With 2 out of 3 Aussies purchasing properties, rising house prices is desired rather than falling. Hence, will the government stop? Yeah, basically, I think the point that's being made there, and it's a good one from Glassdoor, is that there are lots of people who benefit from home prices rising. And in fact, I published a show the other day about who benefits when home prices rise. And the answer is 2/3 of the population. Because those who own property, those who have a mortgage, put those two together, 2/3 of the population, actually benefit when prices rise. Maybe a paper profit, but they actually do benefit, and lifts confidence in themselves. It's the 1/3 who don't have property, it's the 1/3 who rent, it's the 1/3 who are trying to get into the market, who are actually the ones who are disadvantaged. And what's interesting is if you look at the distribution of those two sets of households, the ones who are in the property and those who aren't, I call them property inactive households, then you find a preponderance of lower socio-economic households in that group, of younger people in that group, and effectively less wealth in that group. So in terms of total wealth pools, they are absolutely aligned to property, which means that the government will do a lot, I think. I talk about unnatural acts to try and keep the ball in the air for as long as possible. Okay. What else? Okay. A few other interesting comments. Banks are robbers. Why aren't they being arrested? Good question. Do you know, it's interesting, isn't it? All of the stuff that's come out in the Royal Commission, all of it, has really been highlighting the fact that the banks have been behaving abysmally. The culture's wrong. They're focusing on short-term profits, and frankly, they're breaking the law in some cases. Not on suitable loans and fee for no service. The question to ask is, what is the fundamental set of cultural norms that's driving that? And the problem that I've got is that it's not just one institution, it is the whole sector, whether it's wealth managers, whether it's large banks or even some of the smaller banks. There's something in that about doing it to drive profit short term. We need a different philosophy. And I'm hoping that perhaps the Royal Commission will come out with some observations. But this is cultural. This is the fundamental way that the DNA of the banking system works. It's going to be tough to affect. Okay, Darcy asked, how do you calculate the probability of your scenarios? Well, basically, that's my opinion based on all the inputs that I've got and looking historically over the last 2 crashes. So I've looked at what happened in 2008 and I looked at the previous one and I looked at the different elements and how they all played out and what drove it. So that's how I sort of come up with my probabilities. And it's meant to be a rough guide, because I'm not going to say it's going to be that one or it's going to be that one. I'm just telling you where my sort of sense is likely to be. So that's how I do it. And it's based on history and some modelling and a little bit of intuition. I could well be wrong. Okay, well, we're running over time now, so I think we'll just begin to... May I just say, I've now got 72 patrons, and I want to thank all of those who may be on the stream who have actually supported our work. John and I are very grateful. It helps us create more content. Terrific. If you haven't considered supporting our work via Patreon, please do that. We actually offer a couple of tiers. You can put as little as you want or a little bit more and you get a little bit more. this is really important because we're spending a lot of our time and effort trying to build content that is really powerful and differentiated and different. And this is a way that you can help to show that you're getting value from it and putting value back in. Every dollar that comes through here goes back into creating more content. So I just, my usual plug, but it's important, just I want to explain. And then just a few top hits. So here are just some recent posts that I think are actually pretty useful. I'm just going to go back to the hang on there so you can see it. Yep. There you go. There you go. Okay. So top hits this month. There's a very good post that we put out the other day talking about the Reserve Bank and the way that its monetary policy has failed. That's a really, really interesting one. It's worth watching. There's where are we breaking? Are we with breaking up the banks? That's to do with Glass-Steagall and the importance of Glass-Steagall with Robbie Barwick. There's a post that I did on poor price information in the home loan market. That's talking about the recent Productivity Commission. That's really very important. And then who benefits from home prices? That's the one I updated recently. And finally, another John Adams and I discussion on exposing financial propaganda, and that's where we talked about the APRA and all of the stuff that APRA did. So those are ones that I recommend. They've actually been very popular. We've got more planned, so watch out for some more. I'm just going to have one last look. Mr. Sweetney said, is the custom pledge a one-off payment? The way it works with Patreon is that it's actually a monthly. I am looking to see whether I can extend the mechanisms for contributions, so because I had some people say, I want to sort of give you a one-off rather than actually a regular subscription. But at the moment, the Patreon one is there. But of course, what you can do is to do it for a month and then turn it off again, so you're not committed. Okay, so we're way over time. I did say about an hour. So any last questions? What do you think we will be affected by the Turkish lira dropping in value? If there's no, yeah, possibly. Yusuf, look, the fact is the Turkish lira thing is impacting Spain. It's impacting Italy because both of those countries had effectively significant connections with that. That means that the European Central Bank might get involved in some way. The size of the exposure in Italy, in Turkey, is actually significant enough to actually be a problem. But what I'd be looking for there is the contagion that might flow through to Deutsche Bank. If Deutsche Bank got caught by this, and they've got huge derivative portfolios, that could be enough to actually shake the markets, and that could take us towards scenario 4. Okay, so I think we're done. I want to say thank you very much for your time and spending time with me today. I've had nearly 300 people sitting on the call tonight, which is terrific. Thank you very much for your time and for spending it with me. I do appreciate it. We will do this again. My plan is that we'll do it roughly monthly. I'll probably do it on a Tuesday because that's the day that the Reserve Bank Minutes come out and I can refer to them. I've also got plans to do more interviews with a few other people as well as some more with John. And I've also got, starting soon, we're going to start a series on understanding capital markets, because one of the things that I've learned from talking to people and looking at the stream is that a lot of people don't understand the way that capital markets work. And because they're so critical, I think it will be quite helpful to look at things like how bonds work and the time value of money, and then look at some of the other options and futures and those sorts of things. So look out for that. We'll probably be starting in a few weeks' time with the capital markets series. If you've got other ideas of things you'd like me to research, then send me a message, put it on the stream, or drop me an email. You can go to the Digital Finance Analytics blog and you can contact me that way directly. I have a long list of things. I'm looking at, for example, regional house prices. I'm looking at New Zealand. I'm looking at the international impact in terms of international investors and a few other things all going on at the moment. That will turn out to be another post quite soon. The plan is to continue for the rest of the year to do a video a day. That's the plan. So hopefully by the end of the year we'll have actually had 365 videos up. I'm nuts, I know, but you know, we'll give it a go. We'll do more live streaming. I want to say thank you for what who've watched, and I'm now going to push the button. Have a good evening, and we'll see you next time. And I'm going to hopefully get this time, when I push this button, I'll get the final bell going properly. See you next time. Martin North, Digital Finance Analytics, signing off.